Hello and welcome to this FTI Treasury Talks, where we're going to be discussing the benefits of implementing an intercompany netting process within your organisation. Industry data shows that approximately 70 to 80% of total wire transfers within an organisation can be eliminated by implementing an intercompany netting process. So as if that wasn't enough in itself to convince you to look at implementing one of these processes, we believe that that's just the tip of the iceberg. And that there's many other benefits, particularly from a treasury perspective, that can be gained from intercompany netting. My name's Justin Callaghan, and I'm the CEO here at FTI Treasury, and I'm delighted to be joined today by Shane O'Keefe, who is our Head of Innovation, but more importantly, in respect of this matter, a subject matter expert when it comes to intercompany netting. Here at FTI Treasury, we implement and manage intercompany netting processes on behalf of a whole range of organisations, from multinational corporates to financial companies. And we get to see, I guess, some of those significant benefits that accrue to our clients. And we'd like to share that with you today and try to tease out maybe some of the less obvious benefits that we see accruing. So, Shane, thank you for speaking about this today.
No problem at all.
Start at the basics, I suppose. Yep. Like, in a nutshell, what is intercompany netting and why should people consider it?
Well, intercompany netting is probably the most efficient way of clearing the intercompany invoices between subsidiaries of the same company. Normally we see companies you have two options, either going AP or AR. Most of our clients go down the AP route, as you have the payer has the control of when things are settled in, and you just get all the AP invoices that are in your ERP system, bring it into a netting system where that then will net everything together. So each business unit will have one, well, depending how you set it up, but normally just one settlement per netting instead of having hundreds or thousands of individual payments to all the different companies.
Perfect. So, in a nutshell, you clear down all of your intercompany positions potentially.
Yep.
By having each entity make one single payment in their base currency.
Yep.
To the netting centre.
Yep.
What's not to like?
It makes very, very good sense, I think, from an operational point of view. In a way, it makes everything so much easier.
And tell me, I mean, most people are probably familiar with that concept, and have either thought about this or looked at it, and many, of course, will have implemented as well. But even for those who have implemented change, but like what? I mean, there are some. I think people normally refer to sort of the obvious benefits of netting, right? So a reduction in transaction
costs,
fees, right? Because as we mentioned, you reduce the number of wires dramatically.
Yep.
You're settling all your intercompany invoices with a single payment rather than multiple payments.
Yep.
You're obviously getting the FX gain, right? Because you're able to offset FX, and rather than individual entities entering into deals, probably at terrible rates, let's face it, with their local banks, that's all being done centrally, professionally, by the Treasury. In addition to that, you're able to unlock trapped liquidity that might be there just between, because the invoices are never getting settled and the funds might be in the wrong place, rather being able to centralize them for the greater good, as they say. And then finally, something that pops up a lot is it helps to resolve intercompany disputes, which, as you know, can tie up a lot of time and month-end emails. So I think when people put together a business analysis or a business case for netting, they tend to look at those four things and quantify, evaluate them, and that in itself seems to satisfy the business case. But Shane, from a more treasury perspective, what are other uses of netting that the treasurer can kind of leverage? Having got those financial benefits, the obvious ones.
So it's going to help your FX exposure management, because you're clearing down the exposures of the balance sheet at a time. So if you were doing cash flow hedging, you can have that all linked to the one date. So from a administration point of that, it makes it easier. There's also then, even from your credit facility, external borrowings, it can have a reduced impact on that as well, because Treasury has greater visibility of when netting is actually going to be flowing. And a lot of our clients actually don't physically settle. It all gets settled over we run in-house banks. So if you're running an in-house bank, it just gets booked against intercompany loan. So there is no liquidity requirement, so you don't have to draw down to cover any cash pools or anything like that. So like there's quite a few operational side of it. And then also like from settling treasury activity as well. You have all, long-term intercompany loan interest can be settled through it. You can have all your FX, any treasury related intercompany payments can be settled through it as well, which, significantly reduces the amount of work for everybody.
So you can kind of use it as you mentioned in-house bank. You can used in conjunction with an in-house bank. It can be used to focus all of your cash flows, really, all of the treasury flows and internal flows to a defined date in every month or whatever. So you're saying that you can use it basically to clear down everything. And that obviously makes it easier, as you say, on your credit facilities, but also from a forecasting point of view, perspective. In terms of, people are kind of sometimes put off because they believe that this is a process that, it is a process that touches the whole group of company, the whole organizations. So in terms of sort of implementation and, getting this put in place, can you just talk us through how that sort of works and the difficulties or pitfalls that might be?
Yeah. So, every organization will be different, but like in an ideal scenario, especially with more companies using like, Oracle or SAP, most netting systems will connect directly to your ERP system. So if, depending on your IT setup and resources, if when you're implementing it, you can do that, that takes away a lot of the manual work required at the local level. So you can make it even easier on people. If you can't get that done, every treasury or netting system will have some kind of file upload. So like it's a file download and file upload. So as we're progressing, systems are, the amount of work required is getting less for the users. Like in an ideal scenario, you're just expecting them to log on to the system, 2 days before the netting closes maybe or something, and just do a quick visual check to make sure that they agree what's in the system. So that's making it an awful lot easier from getting the information into it. And like from a treasury point of view then, from executing that, you can connect it to FXall to push the trades directly, so that even that kind of work that the treasury team would have to do previously, it is making it a lot more streamlined and efficient. So if you're starting out in the journey, it's a good time to kind of just, if you can get all the connections at the right time at the start, it will make the job very, very efficient. But that's a high goal to set. We normally see a bit of a hybrid approach where people are, going in, having to maybe upload a handful because they mightn't have fed in correctly from SAP or something like that.
And Shane, I suppose another thing that from a user perspective, that the entity or subsidiary of in an organization, like how easy is it for them to then account for the clear down of all these invoices that they've settled?
So again, depending on how you set up the system, but if we go down the manual route of, the old-fashioned way, is like you get a statement and it is very clear, like it is an itemized thing where it's quite easy to see what you need to clear down. But we see more and more is that with the connection between the netting system, the ERP, the netting system can actually push back a file that will clear down the ERP system automatically for you. But again, that's, at the higher end. But it is a lot of our clients, might have set it up 10 years ago. They'll have some kind of file output, bit of a middleware software to manipulate that into their ERP format and just upload it in that way to clear it out.
Right. So the cash allocation is pretty straightforward. Can be automated if you want. But even if you don't want it, it's simple. Simple enough. Like at a high level, change, like could you talk us through the operational process of a netting cycle? What does that look like from a?
So like from a treasury point of view, we are, our first is agreeing the netting cycle dates. So like, what period is the netting cycle open? What date is it going to close? What day we're going to do the FX trading and what day it's going to settle. So once that's set up, then it's over to the entities, the netting participants, to do their part. So if it's fully automated, they just have to log in once during the netting cycle to make sure they're happy what's fed through. If it's more of a manual thing, they're actually just going in maybe 2 or 3 days before the netting cycle closes and uploads their invoices. And then the netting system does all the calculations. The treasury team will then review that to look at what currency positions are, and they will either do FX deals to close it, to fund the bank accounts or to hedge the exposures. And then it is onto settlements. And there's, from a treasury point of view, there's a payment file from the netting system to make all the payments on behalf of the netting center to the participants. And then depending on how you've set it up again, some systems will do the payments on behalf of the netting participants to the netting center, or sometimes we see that the netting participants have to make that payment through whatever channel they have set up. And then it's a reconciliation to make sure everything has happened, maybe the day after the settlement of the netting, and then it's the clear down of the APAR. Okay. And again, that's dependent on if it's automatically feeding through or if there's a bit of a file upload.
So it's a process end to end that's very clear with steps. I'll probably tell you 4 or 5 days from start to end of a netting cycle.
Yeah.
And you mentioned cash settlement, but you don't have to cash settle.
No.
Is that right?
Like most of the clients that we have, I'd say around 70 to 80% of them would have, where possible, it's settling directly against an intercompany loan and no cash settling. Yeah. It just makes it a lot easier. Yeah. And, like someone will forget to pay one day, someone's off. Yeah. And, you'll have...
Well, it reduces liquidity risks and settlement risk. And so there's all kinds of fun. Daylight overdraft requirements, all sorts of bits and bobs. So it
just makes it more efficient.
Makes sense when you're there. Yeah.
And like, we use as well the netting to clear out non-functional intercompany loans as well. So like, it's just handy to...
So that's a good point. I mean, we've mentioned sort of AP and AR and Treasury, but you can use netting for other things, right?
Yeah.
Like what do you see?
Well,
I know this could be, a wide topic, but just generally, is there one or two things?
So clear out non-functional intercompany loans. It's a very quick and efficient way of doing that, and you're making sure that the FX rates that are being done at are in line with the group policies. Yeah. We also, I've mentioned interest on long-term loan funding. We see that a lot. Some people will do their spot requests through the netting. So like some people will have part of it that if it's one currency, it's going to settle over the intercompany loan. But if it's another currency that they actually want to physically receive that funds, so they'd go onto the netting center and go, look, I need 50,000 sterling, and we'll actually pay it in.
Okay, so it can be used for internal FX
requests. Yeah, it falls into that. And then some of our clients will actually expand it out to external vendors as well.
And how does that work, Chris?
It's pretty efficient. So like the vendor will get a netting statement from the netting system to let them know what companies have paid them, and they're guaranteed, they're happy because they're guaranteed to get all their invoices from the group of companies on a guaranteed date each month. So they're, from the vendor's point of view, they're able to forecast how much you're getting, on the exact day, and it will reduce. Some of the companies will do it that it's their non-functional or currency invoices that they'll put through it. So then that's managing the FX that's their bank was probably taking the advantage of them at, while you didn't have control over that, and you can ensure that everything's done at a competitive rate.
Okay, yeah, great. So lots of uses.
Yep.
The basic uses are obvious, and they have massive benefits. But also, when you put your treasury hat on,
Yeah, you can
lots of
use
other
it
things.
for
Like as a process and as a tool, where do you rate it? Just, you're involved in liquidity management, FX risk,
I think every company should be doing it, to be honest. It's just such an easy one to, like, it's on the easier side of things to implement.
Yeah.
And there are so many advantages, and I just think it makes everybody's job that little bit easier.
Yeah.
So I just see
it seems like
ways
things
a
would
lot.
just make sense.
Yeah.
Yeah. I don't think we've ever done an analysis where it didn't make sense.
No,
Yeah.
the cost savings alone are usually significant,
Perfect.
and then the operational side, makes it easier.
Yeah. Well, Shane, thanks for that. Very interesting.
Thanks for letting me
Pretty
chat
quick,
for a
I
bit.
know, but it's good to hear and get the inside knowledge on it. Folks, you've heard there just some of the benefits and how the process works with regards to intercompany netting. You heard Shane say it, and he's the expert, is that he doesn't see why any company would not be doing this. And that certainly has been our experience. Our clients, when we do the analysis, generally save per annum between $3 and $10 million by implementing an intercompany netting process. That's to do with the transaction costs and the FX in the main. It doesn't take into account the soft benefits that Shane has described, which are pretty much immeasurable in terms of financial, but very measurable in terms of process gain and headcount gain and the likes. We'd love to discuss this more with you if you like. Here at FTI Treasury, as I said, we implement, manage and run netting processes using expert netting software on behalf of a whole range of clients. There's lots more information on our website, www.ftitreasury.com. All of our contact details are on that website as well, and we'd love to talk to you if you'd like to talk to us. Thanks for joining.